Hello, good evening, good afternoon, good morning, and welcome everyone. We have a large audience today gathered here, and I'm excited to bring you back right at the start of the year to our Tech Talk series by Digital at INSEAD. Tech Talk X are both technical and business talks that are presented by leading technologists, thought leaders, industry practitioners, and innovators, entrepreneurs, and INSEAD faculty. Tech Talks span a wide spectrum on both emerging and existing technologies, provide technology-specific insights, as well as management, business, and societal perspective. So I would like to thank our sponsor, Accenture, as well for that. And allow me to briefly introduce myself. I'm Claudia Zeisberger, Professor of Entrepreneurship at INSEAD, and I look after the work that the school does in private equity and venture capital. In the last couple of months, I've spent a lot of time, last couple of years, I've spent a lot of time on the corporate venturing side. I'm dialing in from Singapore today, and it is my pleasure to welcome Kamal Hassan, who is an MBA from 93 and a founding partner of Loyal VC. Is a fund taking an unconventional approach to early stage investing. I've been part of their journey from very, very early on, and it's a real pleasure, Kamal, to have you back. Kamal is also a global director with the Founders Institute, the world's largest idea stage accelerator. He has spent 18 years as a startup, growth stage CEO, startup accelerator director, and angel investor, and he's mentored over 300 startups. He currently holds equity in 80 early stage companies and started off after his MBA as a consultant at Bain. And during his time at INSEAD, he won the Ford Prize during his MBA. Kamal, welcome. Now,
thank you.
We have over 60% alumni in the audience, so I expect this to be a very interactive and engaging event. So Kamal, I hope you're ready for all the questions that were coming. Now, Kamal, let's start off with a brief introduction. So we start a few slides to set the tone, to give you background on what Loyal VC does would be a good way to start the evening. And on that note, I will hand over to Kamal.
All right, thanks very much. Being a good Bain consultant, of course, I need to start with a few slides. But let me just quickly introduce our poker capital investing strategy. Venture capital returns are very reliant on a few deals. Because so many investments fail, returns you get from otherwise good winners just cover your losses. Profits come from the very few deals that return 10 times or more your initial capital, your home runs. Industry-wide, VCs put a lot of effort into selecting deals that they think are home runs, and they succeed only 4% of the time in only 1 of 25 investments. That's a humbling statistic. Smart VCs embrace humility. Bessemer Ventures, perhaps the oldest VC in the US, shares publicly on their website how they said no to Apple, Google, Facebook, and others, all for reasons that seemed very good at the time. So with thousands of brilliant VCs all trying to pick home runs and succeeding in only 1 of 25 deals, we have to ask ourselves, what is the nature of venture investing? Many people treat it like it is cooking, where the right recipe up front can predict your future results. Maybe early stage investing should be thought of more like poker, where it is impossible to know up front which of these 3 hands is best, no matter how strong or weak they initially look, without seeing how the hand develops over time. We at Loyal VC treat investing like poker. Now, the first rule for professional poker players is to play a lot of hands. If you play only a few hands like standard VCs do, your results depend very much on luck. Since home runs only happen 1 in 25 deals, will you have 1 in a portfolio of 15 deals or not? How big will it be? This one event is going to drive the majority of your results. When you play hundreds of hands over time, like Loyal does, you will have a diversified pool of winners, including multiple home runs. It isn't just about playing a lot of hands. It's about smart allocation of capital across those investments. Loyal antes up $10,000 to start every deal and watches things develop. Every month, we offer the top 2% of our companies at each stage a next much larger stage of funding. And this simple top 2% rule forces us to fund only the best. Because each stage is much larger, as you can see on the right-hand column, this results in the top 2% companies being allocated much more of our capital. It's an interesting theory. How has it worked in practice? Here are actual results over the past 4 years. Initial pilot investments have generally followed the VC market. You can see it's down in the past year. They've got a 9% annualized return since launch. Our more informed follow-on investments have exceeded 25% annualized returns to date. And you can see they've generally generated excess returns and significant excess returns in both good and bad markets. Now, how do you operate at scale? One way to do that is restricting sourcing to free up time otherwise spent chasing the next shiny deal. Half of our entrepreneurs are INSEAD alumni, with INSEAD being one of only 2 deal sourcing partners, the other being Founder Institute, which Claudia mentioned. We support these companies with a network of over 700 advisors, half are INSEAD alumni, and about half of our LPs who benefit from the excess returns we've generated are alumni, faculty, otherwise associated with INSEAD. And thanks, we give back to the school, donations, sponsorships, and supporting teaching. Now, VC isn't just about picking the best deals. This is a two-way street. Entrepreneurs need to accept your offer. Our industry is a little confused over what wins deals, thinking big brands win, as shown in gold. What entrepreneurs actually care about is shown in ranking this table in blue. Loyal's poker capital process and our focused INSEAD sourcing is designed to build that relationship, allow us to act with speed, and get the other founder references in the network. The result? To date, 98% of Loyal's follow-on offers have been accepted. Our founders have been loyal because we offer them what they value. So to summarize, a poker capital strategy is built to start with on a foundation of diversification, playing many hands to get more predictable results. Loyal enables this through networks that give us unique access and add value at scale. Excess returns are created by good capital allocation, which involves investing more as the odds turn in your favor and then making sure you win those deals. The patience to invest over years as businesses evolve is enabled by our open-ended fund structure, which I can discuss more if there's any questions, if that's of interest. Thank you very much. Over to you, Claudia.
Thank you very much, Kamal. So let me just maybe start off by making it very clear how your process works for an entrepreneur. So imagine I come to you and I pitch my my latest startup to you. Tell me a little bit about the process, and let's assume my startup does reasonably well over time.
So the first thing is, as an entrepreneur, if you are an INSEAD alumnus entrepreneur and the INSEAD alumnus needs to be working full-time in the business and hold at least 10% of the shares, then you are welcome to come to us. If you are not an INSEAD alumnus entrepreneur, if you're an INSEAD alumnus who's invested in a business you think is a good business, but it isn't an alumni business, doesn't have an alumnus working full-time in it, then we won't fund it. So we have that very simple rule, which restricts the number of companies and deals we see. If you come to us, there'll be one of two things. If you're an impact business, we have a partnership with the Student Impact Fund at INSEAD, and you'll be asked to have an interview with the student fund. They run a parallel sort of deal room basis for us, which is, it gives them a good chance to learn. But we'll be basically asking for a couple of references. We have a founder assessment developed by the Founder Institute, which will tell you more about your entrepreneurial style. But we actually don't listen to a pitch when you come to us. We think pitches can be very biased, so we're not listening to pitches at all. We're simply saying, tell us about your business, a little bit about the history of where it is. We'll talk to some references, have this founder assessment, and possibly talk to the students.
And then as I basically, so the first, let's say I tick all those boxes. I come into your portfolio in round one, then basically you observe how I manage whatever challenges I'm hitting in the next 3 to 6 months. And that to some extent, that learning, that data informs your decision on whether to extend a second to me. Is that a fair comment?
It is a fair comment. It is, there is no specific time hurdle you need to meet. So really what we say to the entrepreneurs is we want to earn the right to invest in your next round. So we have a call with you every month. We offer a call with you every month. We hope you'll take that call every month. But by having this call with us every month, we are doing sort of extended diligence. We get a chance to learn the story. Many of the top startups are actually really hard stories to understand at first. And there's often a joke among entrepreneurs that VCs are stupid and they don't get it. And I've said that many times as an entrepreneur. But VCs are very smart people who don't get it because they're being asked to absorb and deeply understand a new business on a first view, and you'll often miss some of the details. I mean, if you look at Bessemer, when they said no to Facebook, they said, hey, kid, have you never heard of Friendster? It's over, give up. And on a superficial analysis, that is absolutely the right decision to make. But if you sit down and you took time to watch Facebook develop over time, see what their user behavior was like, et cetera, you'd start to realize there's something special. So we want to spend that time to be able to see there's something special. From our point of view, a company, we never say no to a company. We continue to support them month in, month out. It's taken us 4 months to do a follow-on investment. It's taken us 40 months to do a follow-on investment. But we're really there supporting the entrepreneur. We want to see them succeed. They're already in our portfolio, but it's that next follow-on funding is purely how are they doing, and let's see the story over time. And then it's pure competitive. Are they top 2% of our portfolio?
Thank you for putting some color onto the entrepreneurial experience. But we want to spend a bit more time on the fund and how the fund works and how the strategy of investing like a poker player in the VC space actually plays out. Remind us again, how many portfolio companies do you have right now?
291 portfolio companies today.
Okay, so that is a very large portfolio for a early stage VC in particular. So can I ask you, how big is your team?
Yeah, so we have 5 full-time people on the team, and we have 13 venture partners right now and another 2 in trial. Sort of equivalent full-time equivalents is probably about 8 or so, 8, 9 people on the team right now, maybe 10 people. What we do, though, is we have a very different view about venture. Your average venture capital partner will support 5 to 10 deals. The full-time partners, Michael Kosick and myself, are supporting between 50 and 60 deals at a time. The way we can do that is we allocate about an hour per month per portfolio company. We have a call with every company every month, a half-hour call, and then we'll spend some more time supporting extra help where they need it. But the big secret we have is that we've got this network of 1,000 people who are supporting our portfolio companies. That's 700 advisors, the almost 300 other companies, portfolio company CEOs that they can talk to. So when someone comes to me for marketing help, sure, I know a little bit about marketing. I've been an entrepreneur for years, but I should know 10 people in my network who have forgotten more about marketing than I've ever learned, and get the entrepreneur to the right person, the right expert to help them at the time, and not believe as a venture capital partner that I have all the answers.
And let me ask you, I mean, this is, I appreciate you have processes and everything in place, but is it essential to have such a large portfolio? Or is the strategy that you're running possible with fewer investments?
Well, so it depends. The math, I mean, you've got a group out there called 500 Startups, which did it based on the math. And I mean, it's really simple. If you say, if you want a diversified pool of investments, we all know, we all studied it in the CIAD, the diversification, the minimal number is somewhere between 20 or 30 investments. In modern portfolio theory, we'll maybe say it's 50 investments, but it's the tens of investments. Now, if you say, you're going to start, if you start off with 300 companies, you know 200 of them will fail, you'll have 100 companies left. So you can say, I have 100 companies left, I'm diversified, I'm happy. Or you can say, it's really about those home runs. And if it's really about those home runs, well, there's only 4% of home runs. So if you start off with 300 companies, you have 12 home runs. 12 home runs, we're starting to get there for diversification, but it'd be really nice to hit 500 investments and have 20 home runs. So it really depends on, you can do the math and say, I'm happy to just have 100 winners, or you can say, or 20 winners, let's say, which means if you're an angel, you can start off as a minimum portfolio of 60 investments. Or if you say it's the home runs that matter, then you really need 500. And that really depends where you think the math matters most in venture.
Right. So coming back to the winners and those that won't, how quickly do you cut your losses and move them on to the next stage?
Yeah, so we actually are lucky in that we never have to cut our losses. And that's a big difference about poker. In poker, you can end up, you have to make a large bet to stay in, or you fold your hand, and you may often fold a hand and regret having folded it because you see afterwards a low probability event occurred and all of a sudden you folded the winning hand. The nice thing about what we do is you never have to fold a hand. Companies, entrepreneurs will naturally give up as their company starts to fail. But if there's enough in the business for the entrepreneur to think it's still worth them working full time at it, then look, this is one of the advantages of working with INSEAD entrepreneurs. If an INSEAD alumnus feels it's worth working full time in a business, even when it looks like it's failing, they must see something, and we should continue supporting them. So that is the nice thing, is we're always there, we're always supporting, and we've had stories that surprised us that we thought were failing, which have turned around, and after a few years of sort of flatlining, became big successes. In fact, the famous story I love is, I'm Canadian, so I happen to know the details between BlackBerry and BlackBerry. Not a good story today, but was a very good story for a number of the investors in it over many years. They took 10 years to raise their first venture capital investing. Some companies are slow to develop, and you just need patience and be able to wait for them.
Yeah, absolutely. Now, changing topic a little bit. So you and I have talked in the past about investing in women. So I received quite a lot of requests from female entrepreneurs, and I've done research on the topic. And I know that your fund has 30% women CEOs versus, for background, the industry average is about 3%. So clearly single digit. So what about your strategy results in more women being funded? Give us your assessment of it.
Sure. I love looking at sort of scientific studies, because it's you stand back and you say, this makes no sense. Why is this going on? And we can see the numbers happening in the industry. One of the things, there was a study out of Harvard a few years ago where they had an identical pitch done by women and done by men, and listened to by an audience of men and women. And it was just sort of an identical pitch, an identical script read by actors. And the whether or not people thought they should invest in the business depended very much on the gender and the looks. A good-looking man was most likely to receive funding for an identical business, an identical pitch, than a less good-looking man. And all men of all variants of looks outperformed women as well. So that's one of the things we know, is that the pitch process, there's something about the pitch process which seems to discriminate against women. And the nice thing about the way we run things, we make decisions, we admit to ourselves that the decisions we make when we let a company into our portfolio are very shallow, are based on very little data, and may be right and may be wrong. We start with a small pool, so we let a large percentage of those companies in. But the nice thing is, from that point on, we're judging companies based on how they perform. We also ask for references on companies, and we speak to referees about the companies, so that whether or not someone is being modest, and there's been things about sort of men are, the women in the audience may relate to this, I found they tend to, which is that men are often irrationally self-positive about their own abilities with no basis in fact, but they really truly believe that they walk on water. And if you truly believe you walk on water, well, when you pitch your business, other people pick up on this belief, whether it's accurate or not. The nice thing is when we're listening to our reference, that reference will be a more dispassionate reference than an entrepreneur who's full of self-belief. And you can really sort of judge people much more on what they're doing. In fact, the more you judge people on performance, the more you get much more a balanced investing between men and women. And the more you judge people on a pitch and first impressions, the more likely you are to fund good-looking men.
Yeah, and the female element in the strategy was really right from the get-go, and really not what you were focused on. It came a little bit as a surprise, right? When we looked at it a few years in.
Yeah, so it was partially a supply, but I think, I mean, one of the things we're very conscious of is we have a fiduciary duty to pick the best possible companies. If we are picking the best possible companies, we should see a portfolio which reflects the diversity of the pool that we're pulling from. So in our view, it's really simple test, which is if you don't see a diverse pool of companies, of entrepreneurs you're funding, then you are failing somehow in your decisions. So we have measured that since day one. And I think that is an important first step, is to actually measure it. And if you're not seeing a reflection of the pool you're drawing from, then ask yourself the question, why? What are you doing? How do you need to adjust your process? We did find, for instance, it was really interesting, when we were early on with our fund, we had a much higher, on that first check, we have about a 70% acceptance rate. And we initially had a much higher refusal rate from women than we did from men. And so we needed to, so this is the sort of thing that you look at. If you're measuring things, you then say, well, look, we're trying to get both women and men in here, and women are more likely to say no to us. What is going on? And then you talk to the women, you say, what are the reasons you're saying no? What are the things you're wondering about? And then adjust your materials, adjust everything you're doing so that you can deal with that, that lack of acceptance. So yeah, that was, but all of that happens because we said from day one, we want to measure this. We want to see what the diversity of our pool is, because we know that is a measurement of the quality of our decisions.
So before we jump to the move on to the fund structure, we have a couple of questions coming in from the audience. Let me just ask you first, why don't more VCs copy your strategy, or why have we not seen more VCs kind of move at least into that direction? Because it's well founded with by research. By now you have the evidence, you've shown the evidence, and it's popular with entrepreneurs. So why do you think?
So first of all, it's worth saying that a number of the things we do, like the diversity, the large number of investments, there are people like 500 startups who do this. We're not the only firm who's looked at the venture math and said there's something out there. And there's also, I mean, for that matter, when you look at our strategy of small initial investments and really double down on the best, top funds like Sequoia have had their sort of scouts out there for years to build up these relationships with companies early, so you have preferred access to the follow-on rounds. Why people haven't, so people have copied some of the elements of it, or they've independently come to the same conclusions. But to run it the way we run it requires two things. Look, I think first of all, fundamentally, venture capital is a very conservative business. And the reason it's a conservative business is not because VCs want to be conservative, it's because the LPs, the large institutions who fund venture capital, are very conservative in their activity. They only want to fund people who have experience doing venture capital, five-year experience as a partner in an established fund before they want to fund them. And the result is if the only way to get funded is to learn how to do the business in an established business, you're going to copy the way of doing things. I remember talking to, when I was looking for partners to launch the fund with, I remember talking to an INSEAD alum who had just left a large brand name VC fund in Asia. And I described this whole plan to him, and he said, look, this sounds like a really smart strategy to make money in venture. Now, let me tell you about myself. I am used to writing very large checks into a small number of companies and working intensively with them, spending sort of hours a month with each company to really help them succeed. And you can see this sort of, it takes humility to say other people are better to help the companies than you are. But he said, I like the strategy, it'll make money, but I don't want to be part of that business because that's not how I want to live my life. And I think that's it, is it's an industry which the LPs keep it very conservative, where it takes someone who's thought of doing this business differently to come into it, and how many of the existing people don't want to do it. And look, it's hard work. Not everyone wants to talk to 50 to 60 entrepreneurs a month. I do it because I love it, but not everyone, many people would find that very challenging. I think it's a combination of those things. Anyone could do it who wanted to.
Yeah. So you've changed a lot on the way you deploy capital, but it's not just a poker capital approach. You also run an open-ended fund, which obviously requires the LPs to be educated, your investors to be educated. Why did you change so much?
So the open-ended fund was really two reasons. The first is we are just really committed to this poker strategy. And I just mentioned how we can wait 4 months, we can spend 4 months or 40 months before we do the next follow-on. If you are running a traditional closed-ended fund, you're in too much of a hurry. You can't wait 40 months before you see this company's top 2% deserves more money. And that's only the second stage of funding. We do 4 stages of funding. So you can see some companies are going to take a long time. So we were really committed to the model. The model demanded having removing time limitations as one of the limitations from the fund. The other reason we did it is Michael and I are both very experienced angel investors. And we said, what could a fund offer us that we couldn't do for ourselves? Because, diversifying, making a whole bunch of investments, we could do all that strategy for ourselves. But the thing I learned, my best deal, which was actually an investment in INSEAD alumnus Enchanting Travels, my best angel investment took me 14 years to go from the day I wrote the check to the day I exited. And that's fine when I made my investment in my 30s. But when you start getting later in life and you say, do I want to write a check that I'm not going to see any money back for 14 years? That's quite a long time frame. And that was one of the things we said is, we were just very clear from day one, from a customer service point of view, as a limited partner, I wish I could trade out of a venture fund early. I wish I could go through my portfolio and say, I want to buy a chalet in Switzerland. What assets am I going to sell? And I wish that I didn't have to circle all those early stage investments and say, well, I can't touch those. The money's gone. I have to cash out other assets. So we realized up front we needed to do it. So we were just committed to it, which is like, look, we have to do this. It is a big reason, a big asset we can offer experienced angels who could otherwise just invest directly themselves.
Sure. And so what are the secrets to running an open-ended fund? So just for background, open-ended means you have certain times where you can come in and where you can come out of the fund as an investor. So the industry being known in private capital, having a very high requiring a very high liquidity premium to justify the fact that the average VC and private equity fund hold the money of their LPs for a very long period of time. So what are the secrets to running an open-ended fund?
So the big secret to an open-ended fund, and the reason many people don't do it, is you have to be willing to be brutally responsive to market conditions with your pricing. So we set a price, we price all the assets every quarter, and we use that to calculate a unit price for the fund. And then you can buy or sell your units at that unit price. Now, we have some penalties in there for people who sell early to encourage them to hold it at least 4 years. But some people have sold in less than 4 years because they value the liquidity. They'll pay a liquidity premium. But that I think is the number one thing. And it's really a hard thing to do, to be willing to admit to yourself that, hey, the market is down and I invested in this company 3 months ago at a $15 million valuation and a multiple, a revenue multiple, which made sense in the markets of 3 months ago. But in the market of today, that doesn't make sense anymore. And an investment you just made should be marked down. It takes, you've got to be, it's just really hard to admit to yourself. And many VCs find it hard to admit to themselves. I mean, we all know. I can look at a company and say, here's a company I invested in 6 months ago, and the sales are still the same as they were 6 months ago, or the sales have tripled from where they were 6 months ago. We all know, common sense, that one company is worth more than the other company, and we should be marking one up and we should be marking the other one down. And a lot depends on your expectation. I mean, if you expected the sales to double and they've tripled, it's worth more. And if you expected the sales to double and they're flatlined, it's worth less. Part of the challenge is also that people turn to accountants to do the valuation rather than doing it themselves. So we all know and can admit to ourselves the company's worth more or less. But if the valuation is left to the accountants are really judged on their ability to justify what has gone into a valuation. And accounts are very much about, I have a process, I follow the process, it works. I have simple rules, I follow the simple rules, it works. Because that's what they're about, is they're judging your compliance with process. So you do need to take judgments, business judgments, which are challenging for some accounts. Now, we're audited right now by KPMG, and we've done a very good job of going through our evaluation process with KPMG. They agree it makes a lot of sense. In fact, the top people in the valuation, in their valuation team say, this is brilliant. I wish more companies would do this. But it is something which is, valuation is at the core of it. So it's a willingness, yeah.
I can attest to that. So I was invited to join your LP advisory committee for the last 2 years, and I've seen the work that goes into getting it right whenever the gates are up. But looking at the quality of LPs you have, I mean, they seem to be appreciating it. So that clearly they have options, right? They have a gate ultimately. Now, do you, as you are basically growing, I mean, are you still looking for more advisors, surely for more investors, but how about the advisors as well, or anyone who would want to get involved on the fund side?
We are always looking for good advisors, and really for our advisors, we are an opportunity. We are an opportunity for you to, if you like supporting startups, if you like helping startups, it's something you do, and many people, as they build experience in their life, really like helping other people out with their knowledge. We give you an opportunity to do that in a very low demand setting. Every interaction we do is a double opt-in. So you talk to companies only when you have time and only those companies you want to. And then what we do is we share our carry. We take 20% of our carry, the profits we make from our the sort of the fee on profits we make, and that gets shared with the advisors who supported the companies who created that carry. So if you do a good job supporting a company and that company does well, you also get sort of a little something as well. So we are looking for advisors. We are currently open for investors. We're just launching a $70 million raise right now, and to close in June. That raise would take us off the market for the next 2 years. So we become closed to new capital. So we are certainly open to individual investors between now and June. To the extent that fundraise succeeds, we will no longer be available after June. And yeah, we'll see what happens with that race. Okay.
And on the entrepreneur side, I guess I have to ask the question, since we are entrepreneur as INSEADers. So do you think that INSEAD entrepreneurs are better investments than alumni from other schools?
So I would love to say that. The honest truth is, and you can look at the stats, there's lots of other good schools out there. And the reason we use INSEAD as a sourcing partner is we believe that the distribution of results from INSEAD alumni are roughly equal to the venture capital average. So the fact that you've gotten through INSEAD and you're willing to go full-time in a business is a good pre-selection to say you are as good as the venture capital average, which means that more than half of INSEAD entrepreneurs will fail and 4% will be big successes. But we've certainly seen some big successes out of INSEAD. The reason we work with INSEAD is that if we were to go to MIT or Harvard, MIT and Harvard are very good schools. We have very good access in INSEAD. We spend a lot of time really getting out in the INSEAD community and going deep so that we can see all deals, including the best. And we're trying to avoid what's called negative selection bias, whereby if we go to MIT, the best deals are probably snapped up by insiders in that network, and we see only what's left. Whereas with INSEAD, we've got enough of a connection within the network that we hope to see all deals, including the best.
And since we have quite a few INSEADers online, I assume there's some entrepreneurs amongst them as well. How do they go about finding, getting funded by Loyal? What's the next step?
So if you're interested in being funded by Loyal, I mean, the person who handles the intake in our team is Cassidy. You could just write to Cassidy@loyal.vc or write to Kamal@loyal.vc. I'll put you in touch with her. But it's a very straightforward process. Just we're very used to this. So just throw us an email. We'll put in touch. Everyone goes through the same process and be very happy to get you started on it.
Okay. Now, we have quite a few questions. So thank you very much to the audience, as expected. So very interactive. And I will try to sort them a bit, but please apologize if I jump a little bit back and forth. So one of the questions that's right on the top in terms of interest is, how do you decide which are the top 2 best performers in the early stages of investment? So what's your process?
Yeah, so it's a really good question. A lot of people assume there's sort of some sort of tick boxes in the company, which is the biggest number and overall gets the investment. We are still, look, we went back and we analyzed. So we walk in and the team, the investment committee of now 15 people sits in a room together, goes back and forth discussing the pros and cons of the top performers. And it's easy to get down to a top 10% of your portfolio. It's pretty obvious, and many times success is very obvious. But to get from the top 10% to the top 2% is often challenging. We looked at the end result. So we said, okay, let's look at all the companies we ended up picking as top 2% and say, what was the factor which caused that company to be top 10% or top 2%? And 2/3 of the time, surprise, surprise, it was revenues. Either it was B2C revenue growth, or it was B2B trials turning into large contracts, which may not have reflected the revenues yet, but you could see where that was going. Another 20% of the time, it was based on technical excellence, technical success, often showing delivery of that next version of product. And we have companies which are deep research companies, like a company which is pulling CO2 out of the air, but you can see they move from a benchtop version to a version which is a larger version validated by customers. Another 10% of the time, it was just steady progress, a company which just keeps advancing month in, month out. You don't want to bet against them. And the last 10% was based on unusual user characteristics, such as user stickiness, such as the cost to acquire a customer versus the lifetime value of that customer. So it's a mixture of things. And we are sitting there comparing the company which does lab-grown fish against a company which is doing software, B2B software, to help clothing companies sell more fashion, do better performing fashion ads. So you need to be open-minded about what that top 2% is, or you can't be invested in a broad range of companies.
Yeah. So there's a question around the advisors. What particular role do they have? Do you assign them in, how do you assign them to basically the companies that they advise? And can you remind us again about the incentive tools, the incentive structures you have in place for advisors?
Yeah. So we do not assign advisors to companies. We think that's a mistake in the industry, that it's like dating. You want to find someone you like, and you should have a chance to date first and see if it's any good. So it's structured exactly that way. You can have one call with a person, you see if you like them. If you like them, then you have a second call with them. That's all you're committing to, is a second call. The A lot of it now, because we're so large, it's becoming less centrally controlled and much more networked. So it's much more about how do you run a network and design online tools to make it easy for people to meet and find the right person out of this large community. That's really what it is. People will build a profile. You search through profiles as an advisor looking through profiles of entrepreneurs looking through profiles of advisors, find ones who are of interest. Then you reach out to us. We confirm with the other person that the introduction is desired. And if it's desired, we connect them together. The compensation is, there's a group level compensation, which is a certain company generates $100,000 in carry for us. We take 20% of that. So we'll take $20,000 of carry. And we say that $20,000 of carry is going to be split among these 20 advisors who have helped the company. So you could say it's $1,000 per advisor. We actually ask the companies to allocate based on who gave them the most value. So one advisor may get $10,000 and other advisors may get $500, but that's sort of the very simple math of how it works. So the top number is set. There's no guarantee how much you will or won't get. So most of the advisors do it because they like advising. They just think it's fair that we share the money we get with them rather than they do all the advice for free and we get all the money.
Yeah. We have two questions that kind of tie nicely together and goes back to the fund side. So again, how does the open-end fund work with non-liquid assets? Yeah. So how do you basically manage that? And then in that vein also, what are the performance criteria do you use for that?
So the way it works with non-liquid assets is exactly the way it works with Exxon and shares in Exxon, which is Exxon doesn't sell oil wells to cash out buyers. You have buyers and sellers each time. So because we're setting a price each time, we have buyers and sellers at that price. And if you price accurately, you should be able to, we've got gates will kick in. If there's too many sellers, then we will fill the sell orders pro rata. We won't fill them all. To date, we've had 100% fill rate. We've never needed the gates. But there certainly could be market conditions. And we're also very responsive to market conditions. I don't know, when COVID came along, I remember the meeting we had with our LP advisory committee where we walked into the meeting and we said, we've priced all the assets, we've priced in travel's going to be killed by COVID, we've priced that all in. And we said, and we want to apply a 10% discount to the price as well. And the LPAC was looking at us. It's like, why do you want to apply a 10%? We said, look, it's a liquidity discount in the current market. If you remember March of 2020, the market was frozen. No one wanted to buy anything. And we said a freely trading product would have to sell at a discount of 10% in this market. And they sort of looked at us and we just went around the table. We said, okay, if you would buy the assets today with no discount, stick your hand up. And no hands went up. And we said, if you would buy the assets today with a 10% discount, would you invest? And one of the hands went up and we said, okay, that's a market clearing price. So partly this comes back to, you've got to be really responsive with your pricing. And if we're the ones who are immediately responding, including, and we've only done it the once, but including to an illiquid market by discounting the asset, then people don't want to sell that asset. They want to hold on to it till the discount goes away, and they would rather buy other assets which aren't responding as quickly. It is not guaranteed unless you hold the 10 years. If you hold the 10 years and you give us 1 year's warning, then if necessary, we can liquidate assets. So we give you the same guarantee you get in a traditional venture fund. Other than that, it's sort of run a market well, and most of the time the market will work, and sometimes it won't. Don't invest in our fund thinking there's a guarantee of liquidity. There's lots of asterisks. In practice, most of the time, it'll work well with buyers and sellers.
On the thank you. So I think that cleared the question. A question comes in on the investment returns that you had mentioned in your slide. 60% of VC investments return less than the capital invested, suggesting 40% return more. So downside of an investment is limited to the capital investment. Gains are potentially infinite.
Yes.
So would you not think that investing in a diversified VC fund would be preferable in a time of such rapid innovation and disruption, especially for someone young?
I mean, look, this is exactly the math that works. What's interesting is, remember, 2/3 of your deals, 65% of your deals fail. If you run the math, you make it from the 31% of deals make you less than 10x return, between 1 and 10x. The average of that comes out to about 3x. So if you say 65% of my investments, to simplify, give me 0, 31% give me 3x, then you end up roughly flat. And it's the math of the probability of different outcomes, but making 3 times your money back isn't wonderful if you have 2/3 of your deals have failed. So yeah, the upside is infinite, and it's those 4% of deals which have the really big upside. And yes, there's actually a good study out of AngelList, who said that their view was, if you can invest in sort of an index of all plausible companies, that you will outperform people who pick deals 90 to 95% of the time. Because the more investments you can do, the more likely you are to have these mega excess returns, which will just make up for all the losses you've ever had. But that is a question of investing in hundreds to thousands of deals. So yes, that's a great strategy. That's a strategy we follow also. It is a strategy which involves investing in a lot of deals. But yeah, that diversification is a very good strategy and something you should do. Unfortunately, because of the high number of failures, you really do need to do a large number of investments.
And you had mentioned the 291 number before. So people are asking, is this basically your current portfolio? Are those company actives? Are they still around? So have you written companies off? So can you give us a perspective on that?
Yeah. So we add 6 new companies a month to our portfolio. So it's 291 today, and in another year from now, it'll be 360. We have written to zero about 60 of those investments so far. And we're it takes companies an average of 3 years to fail. We're a 4-year-old fund. So we're just on track with the percentage of failures that we expect. What has been shocking to us so far, and it really is shocking, and is possibly part of what's driving our returns, is out of those 60 companies that have been written to zero so far, 55 of them or more have only had $10,000 invested in them. So partly,
which is your first check, which is the first check that you go in.
Yeah. And then the next size up is a $200,000 check. So only less than 5 of them so far have been at the $200,000 level or greater. And partly the excess, there's 2 reasons to drive our excess returns relative to the market. One reason to drive the excess returns is because we have more money concentrated in the excess winners. But the second reason to drive the excess returns is just that we're not losing money as much, because we're more likely to recognize the companies that fail when we're still in a tiny first check. And if you look at venture, imagine for a second that you didn't have 2/3 of your deals failed, and you only had 1/3 of your deals fail, and the other 2, and the 31% that give you 3x became 64%, you would be guaranteed to double your money with 0 home runs. And then the home runs are just gravy on top. So that's really one of the, it's an open question so far, how much of our success is just diligence over many, many months makes it more easier. And picking only the top 2% each month means you don't lose as much money from companies that fail. And maybe we're just making money because of that. Or maybe it is because we truly are building relationships and getting more money to the top winners. It's some combination of the 2.
I look forward to seeing how when the data rolls in, and to having you back in 5 years' time to see how it's going. On that note, up to which stage does Loyal VC invest? Are you purely doing follow-on investments, or are you also in a position to do later stage investments in a company that you did not make initial investments in?
So our view is that we're trying to drive excess returns. I mean, everyone wants excess returns. How do we drive it? We drive it by having a knowledge and relationship advantage. And you can only build up a knowledge and relationship advantage over time. So if you ask me, do I want to put $1 million check into this company, which is coming in through the street, which I've never met before, and I'm just starting to get to know the story, or do I want to put $1 million into a company that I've been doing due diligence on for the past 3 years? Which of these two companies can I make a more informed judgment on? Which of these two companies is a less risky investment? It's pretty obvious where the less risk comes in, is that extended diligence gives you less risk in the investment. So we are always going to pick companies where we start early. So our process is, you can't come in as a later stage investment. You have to be, we take companies in when they're valued at less than $10 million. And our first check is $10,000, because we admit that VCs are idiots who don't know what they're doing when they write the first check. And you learn on the truth about what's going on in the company after you've invested and have spent months working with them. So we just don't want to risk a lot of money until we've spent months working with you.
Right. So one question about your comparing yourself to your peer group. So what do you think is your unfair advantage compared to your, let's say, top 2 or 3 peers?
So we think our unfair advantage is our process. And it's really strange because everyone always says it's the people, it's the knowledge of the industry, it's the brand of, we're really simple. Our unfair advantage is our process, and our process is supported by our networks within CIAD, Founder Institute, and our advisor network. Now, anyone could build those things up. Nobody has them at the moment. So we have an unfair advantage so long as we have those things. But fundamentally, we think this process, this insight of think of this like a poker activity where the future is unknown, invest in accordingly. We really think that is our fundamental unfair advantage. And we've seen elements of this process adopted by others. We haven't seen anyone who's copying the process fully the way we do it.
So I had one question that I just wanted to raise about female founders. Now I can't find it again. Here we go. So I'm gonna basically just relate it. So female founders, you're saying that you're supporting female founders, which is not quite what we said. It's that the process basically leads to you having a significantly high percentage, over 30% of female CEOs amongst your founders. But the question was, does this relate to other minorities as well? Have you
Sure.
analyzed your portfolio?
Yeah, we've got, when you get into ethnicity, it gets sort of tricky, but using the US definition, we have 45% of our CEOs are CEOs of color. I'm trying to remember some stat, which was in terms of Black women CEOs, it's something like 0.04% of all VC funded deals in the US have a Black woman CEO. In our case, we have 3 or 4 Black women CEOs in our portfolio. I mean, you can sort of run through all the stats. One of the things which I think many people overlook, there was a great study by BCG, which said that every dollar invested in a female-founded company returned, the company generated 2.5 times more dollars of sales than a dollar invested in a male-founded company. Now, you could use this and say, VCs should be investing only in women-founded companies. You'll make a lot more money that way. But I think it's just a reflection of economics 101, that because women are underinvested in, the marginal women you're investing in are far better than the marginal men who are being invested in, because so fewer women. But I think many people overlook the opportunity. This is yes, sure, you can do it. Think about it from a fairness point of view, but think about it as an opportunity point of view. You've got this wonderful group of talented entrepreneurs who are underfunded and under-targeted. You will get better returns from investing in the best of an overlooked pool than you will of investing in a fished-out pool, the best of a fished-out pool. So I think I think too many people think about it as fairness and just forget simple money making. If you want to make money, fish where other people aren't fishing, and you'll make more money.
Right. Now, I have one question that I'm going to pick up, because I get this question all the time for some of the entrepreneurs that I work with as well. Is working full-time non-negotiable? If the INSEAD alumnus has an intention to work full-time, currently part-time in the future, but owns 60% of the business? you get this a lot as well. So let's put it out in the open.
So it's a really simple, my answer back again is, if you were sure what you were doing is the next Google, would you not be full-time in it today? And the fact you are not full-time shows that you're not sure what's going to happen with the business. You think it might work, it might not. You're hedging your bets because you have no, and if you're hedging your bets, then why don't we wait till why don't we find the entrepreneurs who are so sure that what they're doing is going to succeed that they're not hedging?
So on this note, I think we are just gonna bring it over the line just in time, or just ahead of time. So Kamal Hassan, founder and INSEAD alumnus, so founder of Loyal VC. Thank you so much, Kamal. Thank you for making time. You're in Canada. It's early in the morning. So really appreciate the questions from our audience. As always, a pleasure to host a webinar. And thank you. You saw at the beginning, there are plenty more webinars coming up. Please go to the website where you registered for this one and sign yourself up. And we hope to see you back at INSEAD soon again. Kamal, thanks very much. Very interesting conversation. We had plenty more questions to fill the time, but unfortunately, we're out of time. Thank you.
My pleasure.